Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us here at AusBiz. Let's get across what happened overnight. Positive session to begin the week on global equity markets as oil prices receded, while Israel said it has detailed plans for at least 3 more weeks of war. Stocks on Wall Street rallied, fueled by gains in AI-related companies, while news that some ships have passed through the Strait of Hormuz without incident buoyed market sentiment, the SIBA volatility index easing. Stocks, specifically Meta shares, jumped on reports that the social media platform plans to cut its workforce by at least 20% to offset costly AI infrastructure and prepare for greater efficiency brought about by AI-assisted workers. Nvidia also rose after Chief Executive Jensen Huang announced new components at the chipmaker's annual developer conference, saying the revenue opportunity for its AI chips may reach at least $1 trillion through to 2027. Taiwan Foxconn, which makes AI servers using Nvidia chips, issued a strong quarterly revenue forecast. Tesla advanced after Chief Executive Elon Musk said the company's Terafab project to make AI chips will launch in 7 days. And Micron Technology shares surged after the memory chip maker announced plans for a second manufacturing facility in Taiwan. And crypto stocks were mainly in the green as Bitcoin hit a 5-week high. Well, US allies have rejected President Trump's call to send warships to escort shipping through the Strait of Hormuz, prompting criticism from the US president, who accused Western partners of ingratitude. Germany, Spain, Italy and the UK said they had no immediate plans to send warships to help reopen the strategic waterway, with Australia and Japan also ruling out sending ships. Meanwhile, Israel says its military offensive against Iran will likely last for at least another 3 weeks, as it targets ballistic missile infrastructure and nuclear facilities. And Iran's Islamic Revolutionary Guard Corps has said it will target US industrial facilities in the Middle East and has urged people living near the American sites to leave. In other news, the European Union has said it's close to finalising a trade deal with Australia. The European Commission President Ursula von der Leyen saying in a letter to EU leaders that this will mark yet another milestone in diversifying Europe's international partnerships, and that the accord would enhance Europe's ability to shape global standards and ensure resilient supply chains. US Treasuries have rebounded on improved risk appetite. The yield on the 10-year slid around 6 basis points to 4.22%, the 2-year dipping to 3.67%. Australian 3-year government bond yields close to 4.6%, the 10-year rising to 5%. Markets have priced in a 70% chance the RBA cash rate will be hiked by 25 basis points to 4.1% at today's meeting. The US dollar index down around 0.5%, the Aussie trading at 70.7 US cents. Oil prices have fallen as President Trump's calls for global efforts to secure the Strait of Hormuz continue, although the war in the Middle East has created the biggest oil supply disruption in history. Brent crude futures down around 2.5% to $100 a barrel. Gold has come under further selling pressure on concerns that inflation stemming from the war could keep interest rates higher for longer. Spot gold at $5,010 an ounce. Copper is up around 1.5%. Iron ore at 110 US a ton. And Bitcoin has rallied, approaching 75,000 US dollars. Well, let's get across those market moves. Steve Sosnick is the chief market strategist at Interactive Brokers. He joins us now. Steve, welcome back to you. So, have you? I see that you're actually quite surprised the market reaction we're seeing at the moment, particularly in relation to where oil has gone. Why is that the case, do you think?
Good morning, Andrew. Yeah, this is one of these scenarios that, as a risk manager, which I was for quite a while, we would draw up the basic scenarios of black swans, and closure of the Strait of Hormuz was always one of the historic black swans that we feared the most, because the anticipated results were supposed to be oil around $150 a barrel, Treasury yields plunging because the dollar would be getting much stronger on a flight to safety, and stocks plunging by about 10% or more as markets were correcting as the result. Well, pretty much that's not what's transpired at all, right? We've got $100 barrel oil, but which is nothing particularly good for anybody, but that's still a whole lot better than 150 to 200 range. We've actually seen the dollar strengthen a little bit, but part of that is because U.S. interest rates went up because of fears of inflationary pressures, either coming from budget deficits to finance the war, or oil-driven inflation. And stocks, while they're call it a little bit less than 5% off their highs, the S&P is down, I think, 2.1% for the year to date. So that's really not much of a move. There's still a fair amount of enthusiasm and complacency. U.S. investors have been trained that despite all these various forays that we've had, and quite frankly, it's a lot of them when I looked at them all one after the other, they've all tended to end relatively quickly and without much lasting damage. So something like Venezuela, whatever you think of the logic of going in and plucking out their president, they were really not a major part of oil markets, and that situation passed very quickly. I think U.S. investors went into this with that same playbook that, the dip is a buying opportunity. If there's a rally, we should chase it, and that this thing will be over relatively quickly. It's not clear that any of that is coming true, but yet stocks continue to have that residual enthusiasm, and we continue to see any improvement in the price of oil, which we got today. Stock traders are quick to jump on that.
Well, let's in fact illustrate this on a chart. We've got the inverse relationship between the S&P 500 and the WTI crude futures. Steve, what is this telling you then?
Yeah, I plotted this out today, our time, and basically what I put the price of oil on there. It's a little tricky to see the price, but the price of oil is on top. That's the candles, and the S&P 500 is the blue line, and you can pretty much see that as oil goes up, stocks go down. Today, it wasn't necessarily as clear intraday, but it's really an intraday thing. And also what this doesn't show is I ran it also back a couple of weeks, and the relationship only really started a week ago Friday, our time, because the first few days stocks were really trying to meander. Remember, the Monday after the hostilities started, the S&P closed up despite oil being much higher. So that's what I was indicating with that residual bid. Now we are starting to see a strong inverse relationship. A lot of that is driven by algorithmic trading. Basically, again, I mentioned the risk management, but a lot of my career was spent risk managing algorithmic trading models and automated market making systems. And what happens is if you're quoting thousands of prices at a time, you need some sort of algorithms to keep yourself afloat and keep your risk managed. And one of the things you also do is try to figure out which factors are moving stocks. And in this case, the obvious factor that's moving stocks and bonds and pretty much everything else is the price of oil. Oil traders certainly tend to have the best handle on geopolitics, particularly when they involve the Middle East. And so I think we're all oil traders right now, whether we like it or not.
So, Steve, no one knows how long this conflict is going to last for, and obviously the impact that the rising oil price is having on inflation, to the point, obviously, that word stagflation keeps rearing its ugly head. I mean, how real is that risk?
Real enough. I mean, part of the problem also is we got a GDP revision on Friday that showed annualized GDP for the fourth quarter going up 0.7%, 0.7%. So right there, that's not exactly a robust economic number. To be fair, we've had some very strong economic numbers earlier in the year, so one quarter does not a trend make. But we're going into a period where we know there's a fair amount of excess inflation coming at us through exogenous factors. At the same time, we're seeing an economy that is not doing particularly well. A lot of trades in the early part of the first quarter were based on a rebounding economy. Now we're learning after two successive GDP revisions, the first at 1.4 and then the second at 0.7, that the fourth quarter was not particularly spectacular. So add in stagnation from a GDP that's got a zero handle, and inflation from exogenous price pressures coming from energy. That's stagflation, whether we like it or not. It's definitely something to be concerned about.
So, of course, this poses a dilemma for central banks, Steve. Our own RBA making that consideration today. Of course, expectation it is going to hike rates yet again, but you've got to bear in mind, obviously, higher inflation, but at the same time, those higher oil prices are effectively a tax on the economy. So, what do central banks do?
Well, right now the feeling for central bank, at least for, it depends on where you are, and the RBA and many other global central banks have been more in a raising pattern than a cutting pattern. But the Fed, who meets on Wednesday, was expected to cut rates certainly by June or July, then another time again by December, and call it a 40-50% chance of yet another cut sometime in 2026. As of the end of last week, that first cut was pushed back somewhere first or second quarter of 2027. As of today, it's moved back pretty much tentatively to December for a first cut, but that's not what people had in mind. So again, one of the pillars behind the stock market was a very key pillar was a solid economy and one where the inflation picture allowed the Fed to cut rates. Well, we're in a very different point of view right now, with given the numbers that we've seen and the factors going on globally, in a situation where we're not getting necessarily the robust economy. The labor market is tenuous at best, which would in some cases indicate it, induce the Fed to want to cut rates, but they're going to be reluctant with energy price pressures that may or may not last for some period of time. As you said, that's a tax on the economy to everybody. And so this is the bind they're in, and rate cut expectations in the US have completely fallen off a cliff. We'll learn a bit more on Wednesday because they should give us a summary of economic projections. And we'll see if they're anticipating one cut, two cuts, zero cuts for the coming year. Remember also, we're changing Fed leadership, but even that's a little slow because we have one Senator Tillis out of North Carolina, saying he's not going to advance any nominees until the government stops trying to indict Jerome Powell. They got dealt a blow on Friday by basically the judge throwing out the case, but they're still appealing that verdict, and so this is a mess. We don't know when the new Fed chair is likely to take office, and whether he's going to be hamstrung by global events in a way that market wasn't anticipating just a few weeks ago.
A mess. Maybe not a bad way to describe where we're at the moment more globally. Steve, great to get your analysis as usual. Thanks for joining us on Interactive Brokers.
My pleasure, Andrew. Talk again soon.
Let's now refocus on our own market just ahead of the open. We are expecting a positive session. There we go. S&P ASX 200 futures there up 0.75%, reflecting what we saw on global markets overnight. So get ready. We're about to do that in just a minute or two. Get across the open. Stay with us.